do it? Why do you think that the government might be considering cutting down on Social Security? Even before this administration's cut, the Social Security, like I said earlier on, was projected to become insolvent by 2034. Sorry, I mentioned 2036 the other time. No, it is actually 2034. It is projected to become insolvent during that time. So there's actually a need for something to be done. And these are some of the things that the policymakers are considering. What are they? One, you're considering raising the retirement age. I know many retirees are not like this. I remember in France just last year, the government increased the retirement age and there was an uproar in the country just based on that, because retirees felt that you can't extend the time I need to retire and work longer. The retirees didn't perceive that as a good solution. So there was an economic disruption in that country at that time. I just picture that and see if that happens in the US, how would the retirees react, or what would be the circumstances when it comes to that? I just want to assume that I feel that when one is very old and you saved up, maybe worked for 35 years and all that, someone is saying work for an additional 5 or 10 more years, I don't think you take that well. I don't think any retiree will take that well. Most retirees will not want to take that well, but that is an option on the table that some policymakers are considering. The other one is reducing COLA adjustment, that is the shrinking benefits over time, whereby slowing inflation. This COLA was supposed to help the Social Security holders have their purchasing power, that is, it will go based on inflation, maybe to some extent edge a little of the inflation, but now they are trying to adjust it by shrinking the benefit over time by slowing inflation based. They're going to now be slowing down inflation based increases, which is going to impact the retirees' purchasing power at that point. That is one of the things they're considering doing. The impact of that is that the retiree Social Security savings from their paycheck now begins to lose value, because inflation would kill the hell out of it if that COLA adjustment happens. The next one is increasing Social Security taxes. No one likes increased taxes, but that is one of the tools that the policymakers are considering. That is reducing tax income. The effect of this is that it's going to reduce take-home pay because of the increased taxes, leaving consumer with less disposable income, which will impact the multifamily real estate. At this point, if people have less to spend, it's going to affect every part of the system. It's going to affect not just the multifamily, because people need to spend for things to really grow, for the economy to grow. What does this mean for you as a multifamily investor? Like I said, I am a multifamily investor, so that's why I'm doing this video, to ensure that everybody understands how different things, the decisions policyholders make, the market, everything that happens, how this thing directly or indirectly affects our investment. So I'm going to dive into what does this mean for you and I as multifamily investor. These fiscal policies can have far-reaching consequences. Number one that I feel that might happen is higher debt cost. It's been really very challenging, especially if you are involved in the acquisition stage. It's been very difficult for you to make the numbers work, because when you have a very high interest rate, the property tends not to cash flow as it's supposed to. So if we're going to have higher debt costs, many deals will not pan out. That means acquisition will go down, because most people don't want to buy properties that do not cash flow, because interest rate has a direct effect on your cash flow or on your profitability. So higher interest rates will lose to slow down on acquisition and make many deals nosedive. Another thing that this is going to do is going to make many investors hold on to their property. So we're going to see very low inventory, because most people that have fixed rates might not want to refinance or sell because they don't want to lose the low interest rate that they currently have. So this is going to be a major issue for the multifamily investment, although we're already facing that challenge. But if this happens, we're going to be we're going to see less acquisition, less cash flowing property, lower margin, because investors will have less cash flow to give out. We're going to see all those things happening. Another effect that this has for you as an investor is rental affordability. So rental affordability concern is another effect that this might have. So if they reduce the COLA adjustment, it's going to slow down Social Security's purchasing power, that is, they will have less money to do things, and you'll find out that those ones that are under the Social Security programs that are living on our properties is going to have an effect on them, because they will not be able to pay, and we're going to see high vacancies, low occupancies, high concessions, rent growth to be almost zero or negative. That can happen because people no longer have the money, especially retirees, no longer have the money to pay. Not just retirees, because just like I mentioned, even when there's an increased tax on their Social Security, that will reduce their take-home pay. So it's not just for the retirees, for every every other person that are in the social security program is going to reduce their take-home pay, and that is going to affect renter. Another one is the potential tax implication. So if they use the tool like increasing taxes, we're going to see potential capital gain hikes. We might see changes to real estate depreciation rules, because one of the exciting things about investing in multifamily real estate is the depreciation or tax benefit. So if they're going to use increased tax as a tool, this tax implication might lead to them changing the rules around depreciation when it involves real estate and multifamily. So this is a very legit fun sign, because I know some of us don't just invest in multifamily just because of cash flow or the appreciation. Some of us invest in it because of the tax benefit. So if this happens, it's a potential. It can potentially affect the real estate depreciation rules. The last point I would like to create here is flight to hard asset, which is beneficial to we multifamily investors. Are going to see so much money coming in, but it has its own disadvantage. Just like I mentioned earlier on, we're going to start seeing people pulling out their funds from stock exchange, 401ks, IRAs, and coming into real estate or multifamily, and reverse. This is a benefit to us, right? But there's a consequences of that happening. We're going to see high prices of those assets, high competition. Some of us might not be able to buy assets for a period of time because the competition is high. We'll see the big boys in town trying to buy these assets, competing with you and all that. So there's going to be so much equity, and that will take out the small players from the market. So how do you protect yourself as a multifamily investor? One of it is to lock down your rate. I cannot overemphasize on this. This is a time for you not to play around with bridge loan or variable rates. Now, lock down your rate because of the uncertainty that we are seeing in the economy. Nobody knows what interest rates is going to look like in the next 1 year or 2 years. Although we can see some people flying out comments and saying that interest rate is going to go down, it's going to go up. Assume that you don't know if any of that is going to happen. Lock down your rate. The second point is prioritize cash flowing properties. For those of you that like appreciation, the property needs to cash flow first. You need to be able to pay down your debts, pay down your operating expenses, and have some little income first before you can even think of appreciating. Because if you don't do that, you'll be paying out of pocket, and before you know it, you might even sell off. And once you sell off, the appreciation that you're looking for, you will not see. So it's important that we start investing in cash flowing assets. And if you're looking for one, contact us. We have deals. Truth be told, all our deals currently are cash flowing regardless of the economy situation. Like I always say, you make money when you buy, not when you sell. We did our due diligence at the beginning. That is why it is able to weather the storm. So start looking for assets that are cash flowing, not just appreciating, but cash flowing as well. The next point is you need to start diversifying your revenue stream. For those of you that are only in the 401k or just in the social security program or just in the IRA or stock exchange, and you're not considering multifamily, I think you are in a wrong place. I think this is going to have a large impact on you. All investments have their own risk, truth be told, but you're looking for investment that has minimal risk compared to the rest. Real estate has its own risk, truth be told, but most of it is based on if there is no experience in operations and if it's not bought right. So two things that can affect the multifamily business is one, if it was not bought right, if projections were not considered properly. The second one is operation. Who is managing it? Are you on top of it? Are you executing your business plan? So if those two things are done properly, it is very difficult for those assets to fail. So that is why multifamily or real estate is one of those stable assets regardless of what is happening in the economy. So if you're just investing in 401ks, IRAs, and all those things that you're investing in, a stock exchange, you need to consider investing in multifamily. And I'm not just saying it because I'm in it. I'm saying it because I'm in it. The risk in it is substantial, but at the same time it is less compared to other forms of assets. So you want to be in that kind of situation where you have less risk compared to other forms of assets. The next thing you need to do is you need to start leveraging on tax efficient strategies like cost segregation, 1031 exchange. These are things that can help you during this time to maximize your tax benefit. You can get a lot of tax benefit that can help you write off your liabilities. So you need to start considering leveraging tax efficient strategies. And real estate, multifamily has a lot of tax efficient advantages that you can leverage for you to write off most of your liabilities. So in some way, I would like to conclude by saying that driven spending cuts can create both opportunities and risk for multifamily investors, while interest rates and potential tax hikes may squeeze margins. Increased uncertainty may drive more capital into stable income generating assets like multifamily. So while there are all these issues going on, this can drive people more into investing in the multifamily multifamily space. So if you're a multifamily investor, this might be an opportunity for you as well. Although, like I've mentioned, there are risks involved. I hope this content was good to you. If you're not subscribed to our YouTube page, what is that you're waiting for? Just go right ahead and subscribe to BB Ofuri on your YouTube page, and on the Facebook page BB Ofuri, and on our Facebook group, it's a Blue Ocean Multifamily group. You don't want to miss this kind of content that we are pouring out or dishing out on a consistent basis. You need to understand how the market or how the macroeconomy or how policies affect your investment. I hope this was good to you. Please have a wonderful day.